Good morning, ladies and gentlemen, and welcome to this edition of the CNBC TV 18 Commodities Camp brought to you in association with MCX. I would like to extend a very warm welcome to our guests here this morning, Mr. Rajiv Agarwal, member of the FMC, Mr. Lamon Rutan, MD and CEO of the MCX, Dr. Chiragra Chakrabarti, Director Deloitte, and Mr. Naveen Mathur, Associate Director Commodities and Currencies at Angel Broking. Well, there was a time when investing in commodities traditionally had a low or even a negative correlation to equities, and in hard times, investors traditionally used to shift out of stocks and into the comfort of hard assets like commodities. Well, there was a time, as I said. At least that's the way it used to be. However, in the recent past, we have seen that there is a very strong correlation with commodities and equities. And one of the reasons that has been propounded behind this is the increasing financialization of commodities and the subsequent ease with which investors can move in and out of commodities. Derivative markets in India have been functioning under the Forward Contract Regulation Act, which dates back to the 1950s. And it's no secret that in the last 60 odd years, the way international business is conducted, the way international finance is conducted, has changed a lot. And therefore, we are here to discuss what changes are required, what policy reforms are required. And with that, I would like to welcome our first guest on stage, Mr. Rajiv Agarwal, member of the FMC.
Good morning to everybody. The commodity futures markets are supposed to serve to the physical market, provide a more robust price discovery, particularly for the future time, and also provide a platform for price risk management.
Commodity futures markets have developed exponentially in last 6-7 years, and they have done a tremendous job in terms of price discovery and the price risk management. But still, further growth of these markets and transfer of benefits, full benefit of these markets to the stakeholders will be possible only when the whole ecosystem develops, and especially the reforms take place in the spot markets.
We have got a physical market, a spot market, particularly in agricultural commodities. It is highly fragmented. It is spread over several thousands of mandis across the country, and the price discovery is being done in pockets. The futures market is a national market, but a national market can be created only when the spot market also is unified.
There is not much of unification of these spot markets even. Therefore, we would like these spot markets to unify, and then the unification of spot markets and the futures market. That will require building up of infrastructure in terms of warehousing capacity, assaying facility, storage facility, grading facility, testing facility, and handling capacity. When all these things will take place, then it will be possible to optimize the trading of the commodities, and the arbitrage between the spot market and the futures market will also be facilitated. This will bring much more competition, and this will reduce the cost of transaction and the cost of intermediation.
We have to understand that ultimately the regulatory capacity of the Forward Market Commission needs to be increased so that it may respond to the regulatory challenges being thrown by the ever expanding market.
The Forward Market Commission is regulating the futures market, whereas other regulators are regulating warehouses and the spot markets. So in the times to come, some kind of unification of these regulatory spaces has to take place.
We cannot consider the commodity futures market as a financial market as the other financial markets are. This market has to remain firmly connected and rooted into the commodity physical market. Therefore, all the policy action in future has to be in that direction.
Thank you, Mr. Agarwal, for your comments on the commodity markets and the kind of policy reforms that are being sought. I would now like to call upon Mr. Lamon Rutan, MD and CEO of the MCX.
Morning, ladies and gentlemen. It's my pleasure to be here. As you know, the Indian commodity markets, commodity exchanges are old. They were about the second to be introduced worldwide after the American exchanges back in the 19th century.
Indian commodity markets are a success story. India was among the first countries to introduce commodity futures exchanges back in the 19th century. And late 19th century, early 20th century, Indian futures exchanges were among the world's leading exchanges, drawing international attention. We are very proud that over the past 7 years we have brought India back to that position. MCX, the largest exchange in India, is now the world's 6th largest exchange. And after one of the Chinese exchanges, the world's fastest growing exchange.
The true value of a futures exchange is to contribute in the development of the underlying physical market. And we've done that. We have a very large gold contract. It will be hard to find a gold trader in India, a gold processor in India, who does not use our platform to manage their price risk.
The sectors where we are active have already seen large benefits. Physical markets have improved. Physical market players are better able to manage their risks. As a result, they are offering better prices to consumers. As a result, producers are getting better prices. We've seen investments in warehousing, in grading, in logistics networks. However, we can do much more if we are allowed to do more. Now, in order for that potential of commodity exchanges to be realized, we need strengthening of the regulatory framework.
Another area where we see that India is losing out and where we could be offering the solution is in service-related contracts.
We can offer products that are now used only by the largest Indian corporates who are able to use international markets. If you look at transport risk, freight risk, this is actively hedged. The risks are managed actively by the largest Indian corporates, but they do this in Singapore. We can bring that market onshore in India. We can open that market to Indian small, medium enterprises. If you look at weather risk is very important. For example, agricultural portfolio lending. The risk of those loans depends to a large part on rainfall. We can offer risk management instruments there that allow banks to lend money more efficiently. This requires the Act to be amended. There are supporting actions like the Warehousing Regulations Act that needs to be strengthened, that should be brought under the umbrella of an organization that understands commodity markets, that understands commodity futures markets. We believe that all of this we are able to deliver once the regulatory framework is in place.
We do need speedy adoption of the Forward Contracts Regulation Act to strengthen our regulator and to widen our possibilities to offer products in the Indian economy. And we need also a more comprehensive view of the strategic importance of properly developing commodity markets, which includes proper spot markets, proper risk management instruments, and proper warehousing. Thank you.